I think a risk for retail investors is, do you have the patience for these longer term investments? Because you might go 3 years and a private fund that has quality holdings could substantially underperform the S&P 500, and that'd be okay. And so that's the risk of trying to time, the private markets. This needs to be a part of an overall, well-oiled financial plan. So those are some of the things that I think about.
That makes a lot of sense. Now, what I'd like to do, just with that in mind, now that we've kind of sort of addressed the elephant in the room, for at least for some people, tell us a little bit about what you specifically do, right? Because you don't do private equity, it's not private credit, you do something called venture. Give us a bit of an idea, and then you have a very unique take on this, by the way, I should offer for people to be able to look at. So this is, I guess, I'm going to stop the screen share here for a minute, and we can always get back to it afterwards.
Yeah, so our strategy that our RIA advises on public and private funds is venture capital. Mm-hmm. Venture capital is a subset of private equity. And a couple of the key differences is, first off, when venture capitalists do a financing round, typically the companies are younger and newer, and so they're not ready for a full buyout. And so we're not replacing the CEO and the C-suite team. We are providing them with working capital to help them continue to invest in whatever their innovation is, which is the second main difference of venture capital. A lot of times private equity could invest in innovative companies, but they just as easily could invest in old legacy businesses and streamline them for efficiencies, right? Mm-hmm. Venture capital almost always is going to be investing in companies that have some sort of innovation. It could be a product innovation like tech, or it could be a business innovation like when Airbnb came out. And it's that innovation that, at least we lie to ourselves when we make the investment and believe that it's going to create a 100x, type of opportunity, because it will displace the older incumbent models. So venture capitalists, almost always a product company, could be retail, consumer product, could be a tech product, something that can scale nationally. We almost always take a stake in the company, and the company has some sort of innovation. And that's really where we specialize.
So just quickly, just to add on that, what you mentioned before, I think this is important to understand. So maybe you just give people a bit of a definition of private equities, or private equity in terms of particularly what does a private equity firm do differently when they come in, when they buy a company, versus what you're doing on the venture side, and which one's earlier stage? Maybe there's a point there too.
Yeah. So typically, there's late stage VC.
Yep.
So they would take issue if I just said, well, VC's early stage. But in general, venture is earlier. And venture is, we call ourselves at-risk capitalists. So, we're taking a lot of risks because the companies, on each individual deal isn't proven. We diversify away the risk by having, a basket of many, many companies, but we're not taking over the company. So typically private equity is buying out the majority stake in the company, or they have a path, to buy that ownership stake in mature, established businesses. So they're targeting profitable, cash flowing companies. Sometimes they use leverage. It's very rare that VC would ever use leverage. PE would focus on things like efficiency, financial engineering, and they have a medium, time horizon. And again, venture, young, very high potential. Investments are equity. And part of this I like, the venture investment itself is preferred stock typically, and that's a pretty simple thing to own. It's not a complex security. And VCs focus on growth rate and market capture and product validation.
Gotcha. So that's an important distinguisher people understand, right? Now, let's just quickly get back to the slide deck or sort of information thing that you sent me, which is really fabulous and full of great information. So I wanted to quickly focus on this here. This is really interesting for people, I think, to see. Maybe walk us through this a little bit about the historical annual returns versus, let's say, the S&P 500. and maybe some other stocks in there.
Yeah. So, and again, compliance disclaimers, it all depends on the dates, and
Yes.
there's so many different reporting, and there's lots of complaints in the private markets on what the reporting is. But, in general, as it should, assets in the private market, and in particular venture capital, has historically outperformed the public markets.
Mm-hmm.
And that is good, and that should be your expectation, because in order to give up that marketability of public securities and you're investing for the longer term, then you should expect a higher rate of return. Now, that's not every year. It's over long periods of time. I think here this is coming straight from a Cambridge and Associates report. There's charts on Morningstar.com. There's charts on Y-charts that go back pretty long, where you can look this up. And to the right, you can kind of see what different people believe this is their go forward. So JP Morgan and Cliffwater had some, I forget what date this was, some pretty good forward-looking statements on venture capital. And then, as we know, we're in this, really, it's fun to ride it, this big bull market on, the S&P 500, which historically has returned, about 10%. And a lot of the same or similar, investment bankers are forecasting, well, what's the next annual return, or what's the outlook over the next 10 years, maybe is not as good as it returns to the norms. As the PE ratios, I think they're like pushing 32, which is pretty high historically. And so that's all this was.
What is this on this, just out of my own curiosity, what is there? I mean, I know Goldman's forecast is about a 10-year view. Unless I'm totally missing something here, I don't see like what the forecast is of these returns. Do you know if it's a 10-year view, or what is it?
I don't remember.
You don't remember? Okay, that's okay. I'm just trying.
Most of them put out are pretty good. Most of them put out quarterly updates.
Yeah.
I know JP Morgan has a great one. Sure. I was actually staring at one the other day, but they'll show like quarterly, annual, and longer term. They typically a matrix or something like that. So. And
I'll share this in full disclosure. Again, obviously, as always, just informational, no advice here. I'm also very much in the camp of somewhere between Goldman and actually somewhere within the whole thing. I think I wouldn't be surprised if the annual return for the S&P for the next decade is low single digits. Let's put it that way. I don't know what that means, if that's 2%, 1%, or 5%, right? Or 6%. But I very much think that's my own forecast, not a guarantee, just my own forecast.
Absolutely. And the opportunity now for the retail or the mass affluent is to consider that long-term view. And let's say you personally believe that, or you and your advisors believe that, to at least start a educational conversation on, hey, if this 3,700 group of companies is going to produce single-digit returns, and if we enter again a lowering interest rate environment where I can't get my cash and liquidity needs met for retirement, then shouldn't we have a conversation about what are the other 7 million companies out there, not all of which are investment opportunities, but shouldn't we have a conversation about the private markets? And I think that's the shift that advisors and compliance departments, TAMPs, OCIOs, money managers, and the like are going to be transitioning into is, hey, for the client's best interest, you need to have a conversation.
Yep. Totally agree. Let's talk a little bit about the next point here. And I think this is an important one. Just the next generation of investors. Talk a little bit about this, because I know, our podcast, we have people of different generations. We've got a lot of boomers. We got a lot of the next generation, Gen Z. What is the Gen Z? Is that sort of the, what age group is that? Do you remember? I can't remember.
I do, because I have 3 of them that were living in my household. They've recent empty nesters. They moved on to college, but Gen Z is basically, I think, 1998 to 2010,
oh, gotcha.
plus or minus a couple years. So they're like 12 to 26 years old, somewhere in there.
Gotcha.
Right?
So I mix it up. I think I'm a Gen X. I think that's what it is, like late 70s.
Yeah,
for a
you and
while.
I are Gen X.
We're Gen X.
Yes.
Okay, yeah. So I got
Yes.
the letters mixed up there. But
So
talk a
Gen
little bit about
Z's,
this. I think this is important.
yeah, Gen Z's high school, college, and recent college graduates. So they're
Gotcha.
entering the workforce. This is the generation that is going to define the next, 25, 30 years. And their perspective of investment advice, and investment products is wildly different
Mm-hmm.
than baby boomers and Gen X, which Gen X is very similar to baby boomers.
Yeah.
And so this is talked about a lot, but not a lot of action is being taken yet. But boomers, this is a chart we got from a report Fidelity Investments put out,
Mm-hmm.
and it's basically showing you a classic 60-40. And
Yep.
so if you went out and interviewed, 100, people that are, anywhere from 50 to 80 years old,
Mm-hmm.
you would get a huge percentage would have a portfolio that looked like that. But Gen Z, again, there's some Gen Zers that are 26, 27 years old in the workforce, got IRAs, some small, they're investing. Their portfolios look a lot different.
Yeah.
And in fact, what's super interesting, if you overlaid, this is saying they have about 45% of their investments in alternative investments, is if you looked at the super affluent, right, the ultra high net worth, it's a very similar allocation. And so I
Yep.
think that's, they're just comfortable. I think they feel like, the stock market, and in some ways that game is rigged or something, that it isn't as exciting as it was when we first started investing, and there was 8 or 9,000 different
Yep.
companies, and it was all in the news. But Gen Z, and I think this is probably led by the crypto craze, right?
Yeah.
So
I would agree.
but that's probably just the canary in the coal mine to say,
Yeah.
okay, that's, if we look at some of the robos like Robinhood, and they were selling the crypto and they get the Gen Z, well, guess what? They're putting out a venture fund, and they're doing some interval funds, and they're doing some really sophisticated things. And so the point of this to an advisor, so I used to be an advisor, is, hey, if you want a thriving business for yourself or for your emerging advisors, then maybe we not need to start again having these conversations about what's a modern day balanced portfolio look like, and,
Yeah.
and maybe it looks like that allocation on the right.
It's interesting. I just literally just had lunch yesterday with a colleague of mine, and we talked about this in a somewhat indirect, but also pretty much to the point way. And one thing that I always talk about this to people. I think it's important to understand that there is a difference between someone who's experienced a couple of serious drawdowns in a portfolio for an extended period of time. I'm not talking about a few weeks or a couple of months, but a few years, and someone who hasn't. And you look at the current market. Certainly here in U.S. markets, we haven't really had any pain that lasted for more than a few weeks for about 15, 16 years, and that's a long period of time. And I ponder, and while I full-heartedly agree with that, the Gen Z has a different way of looking at things, I just have to think about the fact that they haven't experienced pain in their portfolio, that lasted for a longer period of time. But I certainly acknowledge the fact that they do have a different point of view on sort of the alts part, because alts, as you say, it's really, I mean, do you put crypto under the alts bucket? Probably, right?
Yeah,
Yeah. So that's
commodity,
where.
or
Yeah.
whatever it is. But absolutely, if it's not traditional stocks and bonds, it probably belongs in the alternative
Yeah.
bucket.
Yeah. Yeah. Very fascinating. Now, I know we have always be careful with compliance. To what extent can you talk about what your firm does?
Well, definitely, I can talk about our strategy. So we're a registered investment advisor. We do manage a couple of different products, all in the venture capital private markets. Some of the hallmarks or the pillars of our strategy that we try to deploy is patience and diversification would
Mm-hmm.
be the two main hallmarks. Is we'd like to build the nation's most diversified venture fund, and we want to be investing through advisors that hopefully have the patience to let these companies grow and mature over medium to long periods of time. One of the things that makes us a little bit unique, when I was an advisor, we didn't allocate any money to venture capital. It's probably the most under allocated asset class in America.
Yeah.
A lot of that has to do with products, but it's also has been geographically concentrated. So Silicon Valley probably represents 35% of every deal in dollar that is done in America, and that's a huge chunk for a large country. And then you got a little bit more on the East Coast, and the rest is all spread out and disparate. And so one of the things that we've brought to the table is sort of a way to aggregate and diversify deal opportunities not on the coast. And we feel that the coasts are saturated and satisfied by some incumbent players, and so there's really good opportunities, maybe at some lower prices, that you can buy more shares of stock when you're investing in rest of America. So we invest in Canada, sort of the slang is flyover country of America, and a little bit in Mexico.
Gotcha. Now, in fact, let me quickly share my screen as well for that, just so people have access to the information here. I'll just have up your website. I think that's probably okay, right?
Yeah.
So you just take a bit of a different approach in that. People can reach out to you if they want to find out more about what you do, just by going kineticventures.com, right? That's probably the best way to get hold of you, or do you have any other suggestions?
Sure. I'm active on LinkedIn. You can go to our website. Definitely send us inbound there. I always give out publicly my email address. It's my Zapp at kineticventures.com. So any of the three, I will definitely reply.
Perfect. Yeah. No, I really enjoy this because, again, as I told you when we spoke the other day before we decided to agree on doing the podcast, I just think it's important to educate people and open people's eyes, because we've been in such a concentrated market for so long for the private investor, whether it's a boomer or some younger generations, where it's really sort of Nvidia and a few others or nothing in terms of the lion's share of the conversation. And I think it's time for people to educate themselves beyond that, right? It's nice to know another analysis technique, use another chart pattern or something, whatever, on the trading side. But this is critically important on, to kind of educate oneself on some of the larger opportunities, or other parts of the opportunities that are out there aside. And this, in this case, actually going into private markets. So any last thoughts from you, Brad? I've really enjoyed this. This has been very helpful. I think it's going to be very helpful, I should say, for our audience.
Yeah, no, I've enjoyed this terribly. And if you ever want to talk again, or anyone wants to discuss topics of the private markets and what the latest SEC rulings mean, I'd love to continue the conversation.
I might take you up on that. Next time I come across something that doesn't make sense, you're the man for it. Listen, Brad, really appreciate it. I hope you guys also enjoyed this chat with Brad Zapp from Kinetic Ventures. Until next time, be well.